You work hard for your money, you save it diligently, thinking you're building a secure future. But what if I told you that the very place you trust to keep your money safe is silently draining its value? It's a frustrating paradox. You're doing everything right, yet somehow falling behind. The truth is, your savings account is actually losing you money every single day. In today's economic climate, holding cash isn't a neutral act. If you aren't investing, you aren't staying safe. You're actively getting poorer. This isn't just a catchy phrase, it's a mathematical certainty driven by a powerful, often invisible force: inflation. Let's look at the hard numbers. Recently, inflation has been running near 2.7%, while the average savings account in the US offers a meager 0.39% interest. The gap between these two figures is what economists call your real return, and in this case, it's deeply negative. To put that in perspective, imagine you have $10,000 in a standard savings account. After 1 year, you'd earn about $39 in interest, but during that same year, the cost of goods and services would have risen by 2.7%, meaning your original $10,000 now only has the buying power of about $9,730. Even with your interest, you've effectively lost over $230 in real-world value. Now, you might be thinking, what about high-yield savings accounts? It's true, some top accounts currently offer rates near 5%, which does beat today's inflation. However, these accounts face constant pressure as the Federal Reserve signals future rate adjustments. The consensus among economists expects inflation to remain persistent, hovering roughly between 2.2 and 2.7% through 2026. This creates a long-term challenge that a temporary high-yield rate might not solve. The Fed has signaled a pause after potential cuts in late 2025, which keeps any real, lasting relief for savers uncertain. As market rates ease, many of those attractive bank yields will inevitably fall, potentially dropping closer to the rate of inflation, or even below it once again. This slow erosion of wealth is the invisible tax. Your dollars simply buy less and less each month. Relying solely on savings accounts is like trying to swim upstream against a strong current. You might make a little progress, but the force working against you is relentless. So how do you escape this trap? You have to move from being just a saver to becoming an investor. You need to place your capital in assets that have a historical track record of not just keeping pace with inflation, but outperforming it over the long run. Fortunately, you don't need to be a Wall Street wizard to do this. There are accessible, time-tested options available to everyone. In this video, we're focusing on 3 of the most powerful and reliable assets that actually beat inflation. Number 1, broad market equities, represented by the S&P 500. Number 2, Treasury inflation-protected securities, or TEPS, which are designed by the government specifically to combat inflation. And number 3, gold, the classic inflation hedge that has maintained its value for millennia and is showing renewed momentum. Each of these assets plays a unique role. When used together in a balanced portfolio, they can provide a robust defense, helping you outpace rising prices without betting the farm on a single outcome. It's time to turn the tables on inflation. Let's break each one down with simple, actionable steps you can apply today. Our first asset is broad exposure to the US stock market through the S&P 500. Think of this as owning a small piece of the 500 largest and most influential publicly traded companies in America. These are productive businesses, constantly innovating and growing. It's this fundamental productivity growth that allows their value to compound over time, creating wealth that outpaces inflation. History shows this clearly. Over long periods, the S&P 500 has delivered average annual returns of around 10%. After accounting for inflation, which has averaged closer to 3%, that leaves a real return of about 7%. This is the engine that truly grows your purchasing power, not just preserves it. While past performance is no guarantee, the underlying principle of economic growth remains. The simplest way to invest is through a low-cost S&P 500 index ETF. Low cost is critical. A 1% fee might sound small, but on a $10,000 investment growing at 7% annually, it could cost you over $25,000 in lost returns over 30 years. Look for ETFs with expense ratios under 0.1%. Fees are a permanent drag on compounding, so minimize them. Once you've chosen your ETF, automate your contributions. This strategy, known as dollar cost averaging, means you invest a fixed amount weekly or monthly, regardless of market noise. When prices are high, you buy fewer shares. When prices dip, your fixed amount automatically buys more. This smooths out your entry point and removes the temptation to time the market, which is nearly impossible, and prices will dip. Expect volatility. Market corrections, defined as a drop of 10% or more, happen on average about once a year. They are a normal, healthy feature of a functioning market, not a signal to panic sell. Remember, equities require time to work. You should be thinking in 5 to 10-year horizons, allowing your investment to recover from downturns and capture the long-term upward trend. To further boost your growth, ensure you reinvest all dividends. These are small cash payments companies make to shareholders. By automatically using them to buy more shares, you create a powerful compounding effect on top of your existing compounding, significantly accelerating your real returns over the long run. So, for broad equity exposure, the plan is simple. First, pick a single beard no my beard don't mind buy low-cost S&P 500 ETF. Second, set up automatic weekly or monthly contributions. Third, ensure dividends are set to reinvest. Finally, commit to a long-term mindset. You can execute this entire strategy in less than 30 minutes. Next, we'll look at an asset that plays a different role in a portfolio, the hedge that thrives in uncertainty: gold. Gold historically stores value when currencies erode and real yields compress. It surged in 2025 and retains strong momentum into 2026. Some desks forecast elevated prices into late 2026. Easiest route, a physically backed gold ETF with low fees. ETFs store the metal in vaults, sparing you storage logistics. If buying coins, mine purity, premiums, storage, and insurance. Typical allocations range from 5 to 15% depending on risk. Gold can be volatile and may underperform in rising real rate regimes. Deficits and uncertainty can boost demand for safe haven assets. Blended with stocks and bonds, gold can reduce portfolio drawdowns. Set a fixed contribution or add-on dips. Avoid overtrading. Use rules-based rebalancing to keep your slice near target. Keep it simple, systematic, and patient. Now, the instrument designed to track inflation itself, TIPS. A powerful tool to combat inflation is Treasury Inflation-Protected Securities, or TIPS. Unlike regular bonds, a TIPS's principal value increases with inflation, as measured by the Consumer Price Index. This means your coupon payments and final principal also rise, preserving your purchasing power. For most investors, the simplest path is purchasing a TIPS ETF through a brokerage account for instant diversification. It's crucial to focus on the real yield, your return after inflation. A regular bond might offer a 5% nominal yield, but if inflation is 3%, your real return is only 2%. TIPS are designed to protect this real yield, ensuring your wealth is actually growing. Compared to other tools, TIPS are more liquid than I-bonds, which have purchase limits. And while T-bills don't adjust for inflation directly, building a T-bill ladder can boost near-term yield while keeping cash responsive to rate changes. In today's environment, locking in a positive real yield provides certainty. Here are 5 steps to get started. Open a brokerage account, choose your inflation-linked ETF, automate contributions, rebalance periodically, and review your strategy annually. You don't need a lot of money to begin. Start small this week.